Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about what's happening in Egypt. Now, Egypt's a really interesting country because although it's located in northeast Africa, it actually has a lot of characteristics that relate to the Middle East, and it's actually located close to other Middle Eastern countries. And the national language is Arabic, and Egypt is actually the country in the world that has the most Arabic speakers. It's got a population of around 114 million currently, but it's growing rapidly, and over the next 20 years that population is forecast to increase to 150 million. Egypt does have the benefit of some natural resources such as oil and gas. However, it's a net importer, and it's actually been one of the countries that suffered the most as a result of Russia's invasion of Ukraine, because the two things that it imports the most are oil and wheat, and both of those were hit by huge price increases as a result of the world instability following Russia's invasion of Ukraine. And Egypt has never really recovered from that blow, although it's been in economic crisis on and off for around the last 20 years. But up until the last couple of weeks, it was actually on the verge of bankruptcy. It was running out of foreign currency to be able to pay for all of those imports, and so deliveries had stopped. However, it's now been bailed out through a combination of an increase in the IMF loan facilities and also a real estate deal that's been struck with the United Arab Emirates. So in today's video, we're going to talk about what's been going on in Egypt. We'll have a look at what's going on with regards to the balance of trade and the current account. We'll then have a look at what's happening with inflation, because Egypt now has one of the highest rates of inflation in the world. We'll talk about what's gone on with the interest rate, because interest rates have also gone sky high, partly as a result of the fact that the IMF demanded that interest rates were increased. And also I'll have a look at what's been happening with the currency, because as you might imagine, there's been a lot of pressure on the currency. However, Egypt has been managing its currency historically, so it hasn't been operating a free float. So we've had a situation where we've got a black market rate and the official rate, and there was a huge divergence between those two rates historically, as we've seen in countries such as Argentina and Turkey, which means that a lot of people then move to the black market and you get a high degree of dollarization occurring. So we'll talk about what's gone on with the currency and the recent devaluation that the government has announced, which it needed to in order to get hold of the IMF money. We'll then have a look at the bailout deal that's been agreed with the IMF and the real estate deal with the United Arab Emirates. And then finally today I'll wrap up with my summary as to what I think is likely to happen in Egypt over the course of the next 3 to 6 months, and whether or not it's going to put itself onto a sound financial footing, or whether this latest bailout is just another in a long succession of previous bailouts. But before we get started on all of that, once again I'd like to say thank you so much to everybody that's supporting the channel. It really helps me to keep making videos and keep everything going. So if you've bought me a coffee or sent me a YouTube super thanks over the course of the last week, thank you so much. And I particularly wanted to give a shout out to everybody that's joined as a member of Buy Me a Coffee, because that's not something you'd usually think about, but there is a membership scheme there. And thank you for everybody that's signed up, really appreciate that. And also, if you've signed up as a patron or a member, you're providing me with long-term support that firstly gives me financial incentive, but also gives me that motivation, because it's good to know that there are people who are really enjoying the channel and you've signed up as members. So thank you so much. Egypt is located in northeast Africa, but is very close to the Middle East, and the official language of the country is Arabic. The country has borders with Libya, Sudan and Israel, and one of the most important features for the country historically was the creation of the Suez Canal, which links the Red Sea to the Mediterranean Sea and has been a very important trade route ever since it was created. It does have some oil reserves, but these are relatively small compared to a lot of the neighbouring countries, and Egypt is now a net importer of oil. It does export a lot of oil products, but it imports slightly more these days. As well as its oil reserves, Egypt also has reserves of natural gas, and alongside its energy industries, it also has a large manufacturing base where it covers a variety of sectors including petrochemicals, textiles, food, iron and steel. The other main sources of income for Egypt are agriculture and tourism. As we've just discussed, Egypt does have its own natural resources. However, it doesn't have enough to be able to serve its own population, and therefore it has to import things like oil, gas and wheat. and that's putting pressure on the budget in Egypt. It's running out of cash, and it constantly needs to find more foreign currency to be able to pay for all of those purchases. This chart shows Egypt's balance of trade, which is basically the difference between the value of all of your exports and the cost of all of your imports over the last 12 months. And the scale on the right hand side of this chart is shown in millions of US dollars and goes from zero at the top to minus 4 billion at the bottom. And as you can see, in every single one of the last 12 months, Egypt has recorded a negative balance of trade, which basically means that it's spending more than it's earning. And if we focus in and look at what's happened in the last 6 months of 2023, in July, Egypt recorded a negative balance of trade of 2.9 billion. In August, that increased to 3.9 billion. And in September, October, November, and December, Egypt recorded a negative balance of trade of 3.1 billion in every single month. And obviously, the cumulative impact of making these month-on-month deficits is hugely draining on the country's reserves. And if we expand the chart out to show what the position has been over the last 10 years, you can start to get a feel as to why there are so many economic problems in Egypt right now. Because in every single month in the last 10 years, Egypt has had a negative balance of trade. So that means that it's spending more than it's earning. So if you put this into the context of an individual, this would be like running an overdraft and constantly spending more than you're earning every single month to keep that overdraft going up. So at some point, you would have expected that somebody would step in and say, enough's enough. However, when you're dealing with countries, it's very difficult to do that because certain countries in the world just don't have enough natural resources to be able to feed their own population. And that's part of the problem for Egypt. They've got a population of 114 million people, and they're not generating enough income to be able to pay for all of those people. And as a result of that, Egypt needs help, and it needs to do deals with other countries in order to keep the cash coming in. This chart shows the quarterly movements in Egypt's current account over the last 3 years. And the current account is similar to your checking account. It basically says how much money you've got in the bank in order to be able to pay for things. And what this shows is that the current account has been predominantly in deficit in Egypt over the last 3 years. One of the major problems that Egypt has faced over the last 20 years or so is the value of its currency, the Egyptian pound. Now, the generally accepted principle in international currency markets is that you allow your currency to have a free float. So that means that the market determines exactly how much your currency is worth. So on a daily basis, you can check what it's exchanging for against things like the US dollar, the British pound, the Canadian dollar, the Australian dollar, all of those things. And the way that the markets do that is by evaluating the strength of your country, how valuable all of your resources are, how much demand there is for your currency, how stable your government is, what's going on with your interest rates, and a whole host of other factors that all feed into what your currency is worth. But the problem with doing that is obviously if your currency starts to devalue and it becomes worth less and less in the international markets, like we've seen for currencies such as the Turkish lira, it causes major problems because if you're importing goods and the value of your currency is going down, that makes all of those goods more expensive and therefore increases inflation at home. And that can obviously play havoc with your economy. And also it means that your currency becomes worthless in the international markets. People don't want to deal in it. So as a result of that, some countries have decided to operate what they call a managed float. So it's technically floating, so it will move around on a daily basis. The price will go up and down. However, if it moves too much, then the government will step in and start buying to make sure that it stays within the agreed parameters that they've set for themselves. And historically, Egypt has operated this managed float scenario. But the problem with a managed float is that you can suddenly have violent swings in the exchange rate if the central bank and the government decides that they're going to devalue the currency. And that causes problems for investors because they can be looking at the value of their investment if they're an overseas investor in Egyptian pounds looking at the exchange rate. And all of a sudden, if there is a huge movement in any one day, the value of their investment may drop significantly. And as a result of that, Egypt, operating a managed float, has struggled to invite investors from overseas into the country because people are concerned that their investments could be devalued anytime at any point. So let's have a look at what's been going on with the value of the Egyptian pound over the last 5 years. This chart shows the exchange rate between the US dollar and the Egyptian pound over the last 5 years. And as you can see, the shape of this chart is not what you'd expect for a usual currency exchange rate. Normally, you would expect movements up and down, fluctuations. However, over the last 5 years, there's only been a downward trend for the Egyptian pound. And that's as a result of the fact that Egypt has been managing the currency. 5 years ago, one US dollar was trading for 17 Egyptian pounds. Today, it's trading for 49. And since the start of the war in Ukraine, which commenced in February 2022, there have actually been 4 devaluations of the pound agreed by the Egyptian authorities. And a devaluation of the currency is basically where the central bank agrees to reduce the amount that it's setting as its official exchange rate. So in March 2022, the Egyptian authorities agreed to a 14% devaluation of the pound. There was then a further devaluation of around 16% in October 22, a 25% devaluation in January 2023, and most recently in March 2024, there was another 38% devaluation. So in the 2 years between March 2022 and March 2024, the value of the Egyptian pound has fallen from 16 to $1 to 49, which represents a fall in value of more than 3 times. So that means that if you're buying anything that's imported into Egypt, it will now be at least 3 times more expensive. And obviously that's a major problem for a country that's a net importer. Now, in terms of explaining those devaluations a bit further, the reason that the Egyptian authorities have introduced these reductions in the value of the pound is because they're coming under pressure from the IMF to move the currency onto a free float, to let it just float entirely in the international markets, rather than managing the exchange rate themselves. And the reason that the IMF wants it to do that is to stop these shocks that keep happening. When the government announces a devaluation, it means that prices jump up overnight. There is a sudden huge spike in the price of everything that's imported. And also, as I mentioned earlier, if you're an external investor, the value of your investments drops overnight. And as a result of that, investors have been withdrawing their money because they don't want to suddenly hear that there's been another devaluation. And so the exchange rate of the money that they'd invested into Egypt has suddenly fallen further. So moving to a free float is obviously great in theory. That's what the IMF wants. But the problem with constantly reducing your exchange rate is that it drives up prices of everything that's imported and therefore increases inflation. This chart shows the movement in the rate of inflation in Egypt over the last 12 months. And one thing to note here is that the scale on the right-hand side of this chart does not start at 0. It actually starts at 29% and goes up to 39%. And this chart shows that Egypt has been struggling with very high rates of inflation for the last year or more. This time last year, inflation was running at 32%. However, it started increasing rapidly throughout the summer, and by September hit 38%. Now, interestingly, inflation started to come down in October, November, December and January, and hit an annual low of 30% in January, which is obviously still extremely high. But the reason that inflation had started to come down was because Egypt was still managing its currency. However, in February, inflation rose back up to 36%, and it's likely that given the recent devaluation of the Egyptian pound, that it's going to increase further in March. And the current rate of inflation of 36% means that it has the 11th highest rate in the world. The only countries that have higher rates are Argentina, where it's running at 254%. And if you'd like to know what's going on in Argentina, check out the video that I posted recently. Lebanon, where it's 177%. Syria, 150%. Venezuela, down to 76%, which is relatively good compared to where it was. Turkey, 67%, Sudan, 63%, Sierra Leone, 52%, Zimbabwe, 48%, Congo, 46%, and Iran, 36%. And when you look at that list of countries, every single one of them is in financial crisis. And that tells you how severe the situation is in Egypt, because it's right up there with all the rest of these countries. And in order to put the current situation into context, this chart shows the movement in inflation over the last 5 years. And you can see that prior to Russia's invasion of Ukraine, inflation was running at or around 7% in Egypt and had been at that level for the previous 3 years. However, as a result of the fact that Egypt is a net importer and the items that it's importing the most are oil, gas and wheat, it was heavily impacted by the huge increase in all of those commodity prices. And as a result of that, inflation took off. Now, this chart shows the movement in the price of food in Egypt over the last 12 months. And this is something that we always look at when we're talking about countries in crisis, because the poorer people in society spend a much larger proportion of their cash on food. And so when food prices are rising rapidly, it means for a lot of those people that they simply can afford to buy less food. And that's when you get to a situation where people are actually starving. And once again here, in terms of the scale on the right hand side, it doesn't start at 0. It actually starts at 46% and goes up to around 75%. And what this shows is that this time last year, food prices were increasing by 63%. And they continued rising at increasing rates in June, July, August and September, and hit an annual high of just under 74% in September. Now, since that time, there has been a reduction. However, in February 2024, food prices were still increasing by 51%. And the poorest members of society just simply don't have any savings to be able to pay that extra, and therefore are now able to buy less food, and that's why there is a food crisis in Egypt. This chart shows the movement in the official rate of interest in Egypt over the last 3 years. And what this shows is that prior to Russia's invasion of Ukraine, interest rates were at 8.25% in Egypt, which is obviously relatively high, but not uncommon for developing countries. However, over the course of the last 2 years, there have been progressive interest rate increases. And by the end of 2023, interest rates had risen to 19.25%. However, as a result of demands by the IMF to continue to increase interest rates to try to bring inflation back down, the central bank in Egypt recently increased rates to 27.25%. And that means that Egypt now has the 6th highest interest rate out of any country in the world. The only other countries that have higher interest rates are Zimbabwe at 130%, Argentina at 100%, Venezuela at 56%, Turkey at 45%, and Ghana is just above Egypt at 29%. And the problem with having an official rate of interest of 27.25% is that it means that all debt becomes completely unaffordable. Businesses in Egypt will not be able to borrow at those rates and be able to service that debt, and so therefore it discourages companies from taking on any more debt to expand and take on more staff. And also it means that people in Egypt won't want to take on any consumer debt. So effectively, it's going to restrict the money supply, which obviously will mean that demand should fall and therefore inflation should fall. But the problem you've got when you're a net importer is that when you have to buy vital materials such as oil and wheat, you can't just say, I'm not going to buy them, because you need fuel and food to survive. Now, as we discussed earlier, Egypt has been running a negative balance of trade for a long period of time, and as a result of that, it needs to keep borrowing money to survive. This chart shows the movement in Egypt's public debt from multinational institutions between the end of 2014 and the end of 2022. And in terms of the colour coding of these bars, the red section represents debt provided by the IMF, the yellow section the International Bank for Reconstruction and Development, the green section the European Investment Bank, the blue section the African Development Bank, and the grey section are other institutions. And what this shows is that in the 8 years between the end of 2014 and the end of 2022, Egypt's total debt increased from around $12 billion to around $52 billion, which represents an increase of more than 4 times. And as you can see, the vast majority of the increase in that debt has come from the IMF. The red section back in 2014 was relatively small. However, it started increasing at the end of 2016, and by the end of 2022, the IMF's exposure to Egypt was more than $20 billion. And it's now been announced that following the recent devaluation of the currency and the increase in interest rates, the IMF has agreed to provide an additional $8 billion of debt financing to Egypt. In addition to this, Egypt is also in discussions for another $1.2 billion loan for environmental sustainability from the IMF. So this latest deal from the IMF provides Egypt with more breathing space. It gives them cash to be able to pay for more imports. But they've also done a deal with the United Arab Emirates. Egypt has signed a deal with the United Arab Emirates to develop a prime stretch of its Mediterranean coast that will bring $35 billion of investment to the indebted country over the next 2 months. The deal with ADQ, the smallest of Abu Dhabi's 3 main sovereign investment funds, is for the development of the Ras El Hekma Peninsula and could eventually attract as much as $150 billion in investments. Egyptian Prime Minister Mustafa Madbouli told a press conference. Ras El Hekma lies around 125 miles west of Alexandria in an area of upscale tourist resorts and white sandy beaches popular with wealthy Egyptians during the summer months. ADQ said work to build the next generation city over 170 square kilometres, nearly a fifth of the size of Abu Dhabi City, would begin in early 2025. The city will feature investment zones, technology and light industry, amusement parks, a marina and an airport, as well as tourism and residential developments. Egypt's government will retain a 35% stake in the project. Madbouli said the deal will bring in $15 billion in the next week and $35 billion over 2 months, though he said $11 billion of that money will be converted into Egyptian pounds from existing UAE dollar deposits in Egypt's central bank. So what's the summary and conclusion today? Well, I wanted to post this video because I think what's happening in Egypt is a really interesting situation. Ever since Russia's invasion of Ukraine, Egypt has been in financial crisis as a result of the fact that it's a net importer, and the biggest imports are oil, gas and food. And the price of all of those commodities shot up immediately following Russia's invasion. And because Egypt has been running a negative balance of trade for a long period of time, it didn't have substantial foreign currency reserves, and as a result, it's been under severe financial pressure, particularly over the last few months, when we've seen tankers turning away and not delivering their cargoes because Egypt was unable to find the dollars that it needed to make those payments. So it needed something to sort the situation out. And what we've talked about today is an IMF deal where they've agreed to provide another $8 billion worth of debt in exchange for certain things that have been done in the Egyptian economy. So we've seen the currency move to a floating exchange rate for the first time in its history, and that's obviously meant another devaluation, around 38%, on top of all of the previous devaluations. And over the last 2 years, the value of the Egyptian pound has now fallen by around 3 times. So that's obviously putting a lot of pressure onto prices in Egypt, because if you're a net importer, you're buying things from overseas and you're having to sell them to your people in their local currency. Obviously, those prices should be going sky high. And we have seen that inflation has risen dramatically over the last 12 to 18 months in Egypt and is now sitting at around 38%. However, food inflation is up by significantly more than that, putting pressure onto people on the streets. They're struggling to be able to buy enough food to put food on the table for their families. So this is obviously a major problem. So the IMF deal goes some way to sorting out the situation, and also Egypt has now agreed this deal with the United Arab Emirates to develop part of its land into a major metropolis, a new style city. And I think that's a really interesting development in itself, because that's the sort of thing that we've seen China doing over the last 10 years or so. The Belt and Road Initiative that China's been developing means that it's been investing tens of billions of dollars into lots of different countries, and they've been developing ports and infrastructure and some cities. So we're seeing the United Arab Emirates taking the same approach. But I don't think the rationale is exactly the same. China seem to have a different agenda. They're doing that so that they can benefit from that infrastructure, make some profit, and in some situations they've actually taken over ownership of that infrastructure. However, I think the United Arab Emirates are basically doing this because they want to help Egypt. They're coming in to provide the country with some capital, and they're trying to develop this city into a new metropolis that will generate more revenue for Egypt in the long term. So I think the reason behind it is slightly different to what China is doing. But the bottom line is that it's helping Egypt. It's giving them a big chunk of cash right now, which they can use to continue buying things. And in the long term, it may also help to develop income. And that's really what Egypt needs, because continuing to provide Egypt with more debt, giving it more money to keep making imports, is great for the short term, but obviously in the long term, that's not going to solve the problem. We saw from the chart earlier that the debt has increased significantly over the last 10 years, and that's likely to continue over the next 3 to 5 years because Egypt still isn't generating enough cash to be able to pay for all of its imports. So deals like it's done with the UAE to try to develop infrastructure that will generate some income for the country is really what Egypt needs to focus in on more. It needs to do more of those sort of deals to try to get to the point where it's actually self-sufficient. It can generate enough cash to pay for itself. But when you've got a population that is growing rapidly like it is in Egypt, it's currently 114 million, but will hit 150 million in the next 20 years. It's difficult to be able to do that because you're constantly needing to support all of those young people until they get to the point when they can actually start generating income and taxes. So I think the outlook for Egypt over the next 3 to 5 years is going to continue to be difficult. It's going to need more assistance from institutions like the IMF. It's going to need more deals like the one that it's done with the UAE, and it's likely that it will remain under financial pressure. So hopefully you've enjoyed today's episode. You found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.